Hello and welcome to Commodity Culture, where our goal is to make you a better investor in the commodity space. My name is Jesse Day. Before we dive in, standard disclaimer, nothing here is investment advice. Do your own due diligence. And today's episode is brought to you by ARC Silver Gold Osmium. They offer personalized service and competitive prices with no minimum purchase for silver, gold, platinum, or osmium. Here's just some of the comments left on this YouTube channel about ARC SGO and owner Ian Everard. Have bought from ARC, good source and price. I cannot say enough good about Ian and his company. He is the most honest individual I could find in order to buy precious metals. If you are looking to buy precious metals, I recommend Ian at ARC Silver. He is a straight shooter. So go to arcsgo.com and contact Ian Everard today at 307 264 9441 or by email at ian@arcsgo.com and make sure to tell him that Commodity Culture sent you. And today's guest is a veteran of the finance industry with over 35 years of experience, a senior advisor to Von Greyer's AG, and the author of the Things That Make You Go, newsletter. Somebody I always love talking to. It's Grant Williams. Welcome back to the show.
Hey, Jesse. Good to be here. How are you doing?
Doing excellent, thank you. And I want to get started today with a broad overview of markets. You can take this question anywhere you'd like. I'm wondering what the main themes and trends you're currently watching are that you think investors should be paying attention to.
Well, there's so many, right? And this is. They say, may you live in interesting times, and this is a very interesting time. And there are so many different kind of threads that we can pull on when we look at the world from the point of an investor. And I've spoken about this before. I think what you're focusing on is very different if you're an investor or if you're a speculator, and that's always, I kind of bore myself talking about this, but that's the place you have to start. Which of those are you? Because if you're one, you have a very, very different mindset to the other, and you're looking for a set of very, very different things. And everybody thinks of themselves as an investor. But the reality is there are fewer and fewer investors around because investors, by definition, are looking for long-term returns. They're not looking for volatility. They're looking for steady gains and growth and all the boring things that used to be what this game was all about. And we've kind of found ourselves in a world where excitement and quick gains and volatility are what we've become used to. And so more people have gravitated that way. So I think if you're a speculator, then you're just looking for ways to make money in the short term. And there are plenty of places you can do that. Look at the meme stock rebirth we had a few weeks ago with GME and AMC and the like. And so there are plenty of things that you can get involved in, whether it's crypto, whether it's meme stocks, whether it's volatility itself, whether it's jumping on the momentum in the Japanese yen. There are all kinds of things that you can look at. And really, for a speculator, the broader picture is not really so important. You don't need to zoom out too far. You're just looking at momentum. You're just looking at price action, and you're trying to, for the most part, grab a trend that you see in motion, exploit it as best you can, and get off before it ends. And the time frame for that is getting shorter and shorter. Like I said, going back to the GameStop AMC revival a couple of weeks ago, it was 3 or 4 days. And so that's kind of one way to go. And if you're in that camp, like I said, the beauty of it is that you don't need to really understand the world quite as much. The ugliness of it is that you are much more exposed to short-term volatility, and it's a much more psychological test for people. I think is trying to stay on that horse in the short term and have the humility to think you're wrong in a very short space of time, and that's difficult for people because being proven wrong like that, most people don't have the courage or the discipline to say, no, I'm wrong, I'm out. And so the quicker you're proven wrong, the more dangerous it is because you tend to think, I can't be wrong. and I'm going to let that ride a bit longer, and that's where the damage starts. Switching to the investment side of it, which is much more what I focus on, you have a very different setup, and that is you do need to understand the world a bit better. You do need to understand the kind of long-term forces that are pulling at markets and making them do things. You have to have the ability to focus on those and drown out the short-term noise, and you have to be able to do the opposite and stick with something that is going against you and not get out. And again, that's a recipe for potential disaster, because a lot of people, again, will in our monkey brains, we will say, "Oh, I'm right in the long term. I'm just wrong in the short term." And of course, the picture changes every single day. So the greatest long term investment thesis in the world can be invalidated overnight with a press release or a government policy being instituted. And so again, you have to be ready to be wrong. And the common thread that investing and speculating have is you're going to be wrong in both. And being wrong is such an important part of investing and speculating. And the people that do the best are those who accept that and acknowledge that and can mentally and emotionally deal with the idea that, hey, I made a mistake and I need to change my mind. And it doesn't matter, because it doesn't. People worry nowadays because everyone's so public in what they do on social media. It makes it that much harder to admit you're wrong. And you see this all the time. You see so many dogmatic discussions on social media. People dig their heels in and they refuse to change. And so it's really, really difficult to be either at the moment. So it's a very long-winded preamble. But for me as an investor, obviously looking at the markets and trying to decide what's important, unfortunately, geopolitics is a huge, huge component of what's important right now, because on the one hand, we've got an awful lot of tension at a geopolitical level in the world, which is never good for kind of long-term planning for investments. And on the other side of that coin, we've got an awful lot of heavily indebted governments in the world, many of whom are facing elections, and many of whom find themselves in very deep fiscal holes. And so if you take those two things as an important backdrop, let's forget markets per se at the moment and focus on geopolitics. Once you zoom in on those two things, you realize it's a very, very toxic combination for trying to commit capital to any idea, because on the one hand, as I said, these governments are heavily indebted, which isn't necessarily a bad thing, or I should say hasn't necessarily been a bad thing, because they've been able to use quantitative easing and low rates and all these things to keep a lid on that. But when inflation came back a couple of years ago, post-COVID and post the fiscal largesse that was liberally dosed around the world, it changed that. It changed the jeopardy of having those heavy debt levels on the government balance sheets, because it took away their ability to just blanket, keep rates low and service their debt and borrow more and be able to fund the service of that debt. So now we have governments on one hand who are heavily indebted, inflation standing over their shoulders, ready to come back at the first sign of an easing of rates. And everyone, from the governments down to the personal balance sheet, is dependent upon lower rates, because that's what we've become accustomed to having over the years, and people adapt. So if low rates is the status quo, everybody over time alters their way of structuring their own personal situation around the status quo, which is low rates. So the jeopardy that these governments are in mean that they will necessarily be, I like to use the word grabby, when it comes to private capital. And that means on a tax basis, they will be looking to generate higher revenues to if nothing else cover their debt service costs. And on a geopolitical level, as we're starting to see now more and more, impose tariffs to even the playing field domestically. You throw in the election where, and I'm talking specifically about the US here, but there are others. I think South Africa goes to the polls today. And we'll come on to why that might be important in a short while. Election cycles tend to be periods of time where governments like to grease things by being a little bit more generous than they normally would be, and offering. Let's stop short of using the word bribes. Let's call them incentives. How's that to people to vote for them? And we're seeing this in spades in the US with some of the policies of the Biden administration. The recent release of $1 million of gasoline ahead of Memorial Day weekend. I mean, it's just blatant politicking that, from a fiscal rectitude point of view, is ridiculous given the state that the country's in. So that's the backdrop, and against that backdrop of fiscally impaired governments, election cycles, inflation waiting in the wings, what we have is really a perfect setup for commodities. I mean, it really doesn't get any better than this, apart from one caveat, which I'll come on to in a second. And so there's a lot more focus being put on commodities. There's a lot of smart investors who have been reconstituting their portfolios to have a much bigger allocation to commodities in recent months. And you're starting to see that in the price action. You're starting to see commodities starting to break out of multi-year chart patterns. You're starting to see more and more people talk about commodities. You're starting to see more and more people recommend commodities. You're starting to see more and more speculators come into commodities, which is good and bad if you're an investor, because it will increase your volatility and certainly change the way you think about price movements. Even investors will get giddy when the speculators come in and drive these things up before they get crashed down. So if you're a long-term investor and you're used to these nice quiet bull markets where you get in early and you just sit and you're patient, suddenly the volatility comes in and it gets a little bit tricky to handle. The one thing, obviously, that's the kind of big question mark over this perfect setup for a commodities bull market is lower growth around the world. And so the kind of the naysayers will tell you, well, where's the growth going to come from to fuel commodity price increases? And this is where I think what gold is telling us recently becomes actually very important. We've seen gold now, I think it's at $2,370 today, give or take, just slightly below $2,400. And let's just take that statement in isolation for a second. As someone who's been focused on gold for almost 25 years now, let's think about me casually talking about gold hovering just below $2,400. That is a massive, massive change. $2,500 was always seen as for a lot of people, oh, do you think is gold one day going to break $2,500? And we've now seen $2,000 become a very distant floor in the gold price, and 2,000 was a top that gold couldn't get through for 2020 odd years. So everything's kind of changed very quietly, and everyone is focusing on the gold price, right? And I've spoken about this for many, many years. I've given presentations on this, and my contention is, and I'm sure there are people out there that disagree with me, which is absolutely fine, but I think there are two prices. One is the gold price, and the other is the price of gold. And there's a very distinct distinction between the two of them. The gold price is what I just said, it's $2,370, and it's on a screen, and it's a number that's quoted on futures exchanges, on the COMEX around the world. There's a spot price of it, and that's the gold price. The price of gold is very different. The price of gold is what you have to pay to secure an ounce of gold in your hand, and they're not always the same. There is nearly always a significant premium on gold coins. If you want to buy a gold coin, you're not paying spot for it. And those premiums fluctuate. And so when people focus on the gold price and they talk about, well, we're going to break out of 2,500 or we're not going to break through 2,500, that's going to be a ceiling, that's a resistance. It's kind of pertinent if you're a speculator, but if you're an investor, it really isn't. If you're investing in gold, and gold is different in so many ways to just about every asset that you could think about taking a position in or looking at. And when I say gold, I include silver and I include platinum in that. I'm just talking about precious metals, but I like to just keep it simple and talk about gold because they all have similar characteristics. Once you look at gold as an investment, what are you really investing in? Because if it's about the price, you're not investing in gold. You're just speculating on an asset that you think is going to go higher in price, and that's totally fine. You can have a long-term view, you can have a short-term view. It's totally fine. But to me, investing in gold means I want to hold my surplus capital in an asset that's going to protect my purchasing power, that is going to allow me to be confident that over the long term, I'm not going to be debased in my purchasing power, as I will absolutely be guaranteed to do with fiat currency. And what we've seen happen in the last couple of years, since a few days after Russia crossed the Ukrainian border, I think is incredibly significant. And more and more people are starting to understand what's happened. And more people are starting to realize the importance of it and the connection between what's happened and the price action in gold. And that was not necessarily the Russian invasion of Ukraine, but it was the US Treasury's actions in freezing the assets of the Russian central bank. And I spoke about this at the time, and I wrote about this at the time. That to me was arguably the most significant piece of news in the gold market since August 15th, 1971, when Nixon closed the gold window and took the world off a gold standard. And the reason is very simple. It's not obvious, but it's simple. And that is, as soon as the Treasury did that, as soon as the Treasury froze those Russian central bank assets, they sent a message to every central bank in the world, friend or foe, that this could happen to you. You could have your sovereign national reserve assets frozen at the whim of another government. And the reason that's important that it was the US Treasury is that thanks to the dollar being the global reserve currency, and thanks to the dollar being the world's energy currency, every single central bank in the world holds US dollars because they have to pay for their energy imports or they receive dollars from their energy exports. So you've had the US Treasury say, right, if you own dollars, which is everyone, tick, that's us, there's every central bank in the world, there are a set of circumstances under which we will freeze those and you will no longer have access to them. And you could be the most staunch US ally in the world, but you don't have a choice at this moment in time. This is a national security concern now. You cannot have access to your reserve assets frozen. So you have to come up with a plan B. You have to have a plan to mitigate that possibility. And you don't have to do it. No one's going to dump all their dollars and buy another reserve asset that day, but you have to diversify. You don't have a choice. And that's what's been happening. We saw record central buying of gold for 2 years and counting. I suspect we'll see the same again this year. And people kind of noted that. Isn't that interesting? Central banks are buying gold again. But it's a lot more than interesting because this is not a choice they're making. This is a need they have now. They need to diversify. They need to be more resilient. They need to be more robust. They need to be more independent of the system. And the system I'm talking about is the dollar-based reserve system. So what you have now are people like me who are looking to protect their long-term purchasing power, but also their own sovereignty. And these buyers of gold now are completely price insensitive. They have a need to diversify, sell their dollars or their dollar-based assets, reserve assets in this case, treasury bonds, and replace it with something. And that something needs to be neutral, check, that's gold. It needs to be nobody's liability, check, that's gold. It's the perfect solution to this problem. In fact, it's the only solution to this problem. And so that's what they're doing, not through choice, but through need. The fact that the Treasury have subsequently, a short time ago, decided to appropriate those Russian assets and use the money to send to Ukraine or do whatever they want to do with it only makes the imperative that much greater for these central banks to get hold of gold. So this is what we're seeing. Gold sitting below $2,400. The price, it doesn't matter to the central banks. They're not waiting for a pullback to 2,200. They're not looking at a chart and saying, hey, I think this could see 2,000 and then we'll really step in. No. And you've seen, if you look at the charts, you've just seen relentless buying from these actors. And that changes dramatically the setup in the gold market. And this broadens out into other commodities. What we're seeing in copper is a similar phenomenon. It's not that they need to buy copper, but this need to diversify into other assets. These countries all need copper. China particularly is going to need an awful lot of copper to build out infrastructure. So we could hold our assets in copper. There's no sell-by date on copper. We know we're going to have to use it at some point. We know we're going to have to buy it at some point. So let's buy it now. So this is what we're seeing in the commodities world. And if you throw in the extreme at which this is happening, there's a great chart that's been doing the rounds this last week of the commodities to NASDAQ ratio. And you will see just the most perfect double top going back to 2000 with today. And you've just started seeing the pendulum swing very slightly back towards the commodity market. And just shows you how far we've got to go. This is where we are. And so I can't believe what an incredibly long-winded answer this is. I'm really sorry. You've got me on my soapbox now. But this is where we are. The world has fundamentally changed. And for the investor who has a more long-term mindset, you can look at this trend, you can extrapolate it, and you can think to yourself, okay, I can see the direction of travel now. And whilst past isn't always prologue, particularly when it comes to asset prices, you can see a major shift in trend here in terms of who the buyers are and their reason for buying. Now, that gets dangerous if you're a speculator because you start looking for reversals and you think, oh, gold's gone a long way, it gets extreme here. And so it clouds the ability to be successful for the speculator. But this is where we stand. We stand in a world where gold is now a much more preferable reserve asset to US Treasury bills, much more. And the reality is it always has been, but people have been happy to own Treasury bills instead for the liquidity it gives them, for the flexibility it gives them. And people need to understand that and recalibrate accordingly. And I think that recalibration is going to mean significantly higher gold prices particularly, but that is going to drag along an awful lot of commodities with it. And I think we're on the cusp of a major bull market in commodities in general and precious metals in particular. Phew. Okay. All right. How's that? I'm going to have a drink of water now. Are we run out of time
Excellent. Yet? I believe you have actually just beaten Adam Rosenzweig for the record for longest answer ever given on this program.
Oh my God. Adam will be so grateful to me. He'll be so grateful to me.
But no, incredible commentary there. And we love diving into the details on this show. So that is amazing. Is some caution warranted here as a commodities investor? Because obviously myself and yourself and a lot of people who research the space, and I'm involved every week talking to people who are bullish on the space. I hear the same thing a lot. We're on the cusp of a commodity super cycle. We've obviously seen the prices of gold, silver, copper, uranium doing very well. My own portfolio, which is basically 100% commodities, has been doing very well, but it hasn't been doing as well as Nvidia and the broad market. And it seems like things don't make sense. They don't add up. When we see Nvidia continue to rip insanely higher, We're seeing the GameStop phenomenon, as you mentioned, that was sparked by a man who calls himself Roaring Kitty posting a meme on Twitter, caused GameStop to spike. And then Andrew Tate comes on and says, I'm going to buy GameStop till the end. And then RFK posts on Twitter that he's buying GameStop, and apes together strong. And it's just like, somebody posted under that, we are truly living in a simulation. And that's kind of what it feels like sometimes today when it comes to markets. So I'm wondering, everything you say makes so much sense when we come at it from a logical and rational perspective. Is there any reason to approach the commodity space with caution for the fact that we're seeing so much madness and insanity in the broad market that maybe things won't quite play out as they logically should?
Yes. There you go. How's that for a short answer? Look, there is always you have to approach these things with caution. And that's why I said what I said at the top of the show, because just because the setup is really good and just because everything points to a particular outcome, you cannot assume that that's going to happen. You just can't. And let's strip back what we're all trying to do here, right? What we're all trying to do is make, I was going to say a prediction, but a guess. Let's face it, it's a guess about a completely unknowable future, right? That's the business we're all in. We're all fortune tellers. And some fortune tellers, frankly, suck. And that could be us at any given moment in time. So the best we can do is take the time to construct an investment thesis and a framework within which to operate that thesis that works for us and nobody else, just us. Wait for the right setup, implement that investment strategy, apply appropriate risk controls, which is, what if I am wrong? What if this doesn't play out? And then hang on for grim life and be ready to admit when we're wrong. That's it. So just because I think we're on the cusp of a great bull market, or just because any of your other guests do, doesn't mean it's going to happen. And I know that going in, I'm absolutely prepared to sell everything I own if I think that setup goes away. But what you said there, Jesse, was really, really interesting. You talked about the commodity market potentially being on the cusp of a super cycle. And in the next breath, you talked about Nvidia. And the next breath, you talked about GameStop. And this is one of the fundamental problems that people have today. And that is, if you are thinking about a multi-year commodity super cycle, what relevance does the price of Nvidia have to that? Now, some people might argue on a technicality, well, semiconductors are a commodity. That's fine. I will accept that argument, but it doesn't alter the fact that the price of Nvidia stock has no bearing on that, because we all have seen what Nvidia's stock price has done. We all know that in that stock price is an awful lot of froth and FOMO, and an awful lot of what stock markets do, discounting the future. Nvidia is priced for the chips that they're going to sell once the AI revolution, hits the streets and power to the people, and we're all AI now. So that and GameStop and Andrew Tate, what commodity investor who's looking at commodities as his thesis and applying a framework should give two hoots what Andrew Tate says, or RFK for that matter? RFK, if he became president, could be a problem in terms of taxes and the way he might handle things. But I don't think Andrew Tate is any commodity investor's priority, and we shouldn't be focusing on that. And that's where these kind of the little angel and the devil on your shoulder will pull you away from what you're trying to accomplish here, because of this. Everyone's talking about Nvidia, and there's people are making fortunes in Nvidia. And my commodity bull market thesis is I haven't made any money today, and Nvidia's up 10%. Just take a look at what gold has done over 50 years, over 20 years. These are not common investment time frames, and gold is not a common investment asset. And you don't buy gold to appreciate on the price. Generally speaking, there are people who do. I don't. I don't want to buy gold and have it incredibly volatile and spike up and shoot down. I've never sold an ounce of gold I bought and I never intend to. But let me clarify that, because this is again about a mindset when it comes to gold. Um, I saw my buddy Brent Johnson on Twitter the other day make a very, very good point. And he said, if you buy gold or Bitcoin and you never intend to sell it, what's the point of owning it? And he's absolutely right. When I say I'm never going to sell an ounce of gold, that's a mindset I have to help me take my focus away from the price. Because if you are a seller, sometimes a price gets a little halo around it and you hear these angels singing, and it goes through 2,500. You go, I've got to sell, 2,500 is too high. I plan on exchanging my gold for something I want to own more at some point in the future, potentially. If I don't find anything that I want to own more, I'll hang on to the gold. And I use this example regularly, and I'll use it again because it's a personal one to me, but it's a very relatable one to many people. And I always use the example of Sydney real estate. A harbourfront property in Sydney, which for anybody that knows the Australian property market is, beyond insanely priced. But if you look at Sydney harbourfront property in terms of ounces of gold, a very different picture emerges in terms of what the price of Sydney property has done. And I haven't looked at it for a while because, as I say, I see this long bull market ahead of us, and I'm not looking to do anything on my gold. But pulling numbers out of my head, and people can pull up these charts. If you go back to, let's go back to 2008, say, gold sitting at $800, $900, and the price of a Sydney house is probably, let's say the average harbourfront property in Sydney is $5 million. At $900 an ounce, someone else will have to do the math for me, but you need a certain number of ounces of gold to buy that property. Today, that price of the Sydney house has at least doubled, maybe more. But gold has done likewise. And I don't know what the exact ounces are, but in dollar terms, that Sydney harbourfront property is now completely unaffordable to most people. If you still have your gold from 2009, it's give or take as unaffordable as it was back then. But if you just needed a little bit more to be able to get the house, you can still have that. And that's put you in a better position than most people. If we get a 30% correction in house prices in Sydney, that's still going to make those properties unaffordable to most people. But if you still have that safety deposit box full of gold that would have almost bought you that house 10 years ago, the chances are you'll be able to exchange that gold for the house you want, wash your hands, and have that house as your main asset. And so that's why this mindset of buying and selling is incredibly important to understand. And again, I don't want to labor the point too much, but if you are a speculator, understand that it's all about the price. There's a price that you will sell because you think the price has gone too high. Totally fine. There's a dip that you will buy. Also totally fine. If you're an investor and you understand the reasons you're investing in it, it's a completely different mindset. And the price can be a distraction rather than looking at, okay, if my goal is to exchange gold for something I want more, you open up an entirely different universe. And I would argue, forget property, take a look at all sorts of other assets around the world that you might want to own and see how much gold, not at what price they are, but how many ounces of gold would you have to give up to exchange for those. And I think once you do that, you will find that the world looks very, very different to you in terms of affordability and value.
Very fascinating breakdown once again. I wonder what your thoughts are currently on emerging markets, and maybe if we could shift the focus as well to commodities in emerging markets, whether that's Brazil, China. Actually, I'd love to get your thoughts before we dive into the whole spectrum of emerging markets on, is China actually an investable market? Because we saw the sanctions that were put on Russian equities. When that happened, China is obviously the next big enemy in the crosshairs of the U.S. regime. Do you think it's safe right now to allocate capital to China as a Westerner?
Okay, let's look at that question through the framework about which I'm talking, because my answer to you is no, because China's investability or otherwise does not suit my risk profile. So to me, it's completely uninvestable. I have great friends, people like Louis Gave that will make you an incredibly strong investment case for China. So people ask those sort of questions. Is China investable? They always leave off the two most important words from that question. Is China investable? Is China investable for me? That's the crucial thing, because you can hear someone give an incredibly cogent explanation as to why you should be all in on China. And a lot of people get seduced by that. They get seduced by the opportunities of gains that these people see. And they don't bother to sit back and go, okay, but if I do that, does that fit within my risk tolerance? Does that fit for me as an investor as opposed to speculator? Do I have the patience to? There are so many more questions that come after you add the words "for me" to any of those questions, and that's the kind of blessing and the curse of social media, of podcasts like yours and mine, and my newsletter, and all these things. That is the blessing and the curse. You are given insight from an awful lot of smart people as to what they believe makes sense or offers value or should be avoided. And we've become so used to outsourcing the next part of that, the thinking, to the guy that we just heard on the microphone. And instead of taking that information and then saying, okay, here's what that guy is saying, it makes sense. Now, here's the crucial question. Is it suitable for me? And that requires thinking, and it requires discipline, and it requires work. It requires taking that information and digging deeper. And this is why I have a real bugbear about actionable trade ideas, because to me those are hugely dangerous things in the wrong hands. And by definition, they will get into the wrong hands, because the people who are most predisposed to actionable trade ideas are the people who just want to be told what to do. And that's okay, because we all need a bit of help. But the difference with an actionable trade idea, as opposed to advice about your girlfriend or how to parent your kids, is if you take that advice from an investment perspective. If you go to your buddy and go, listen, my wife's causing me all kinds of problems, or my husband's causing me all kinds of problems, what do I do about this situation? And they go, well, have you thought about this, that, and the other? They're giving you some advice for a moment in time, a specific situation that you might want to follow. Generally speaking, it's probably best not to. But that's it. You deal with that situation and you see what happens. If you take an investment advice on an actionable trade idea from someone who's most likely a stranger, you're familiar with them, but you don't know them. The second you take that advice and you put that trade on, the responsibility is yours, not theirs. They have zero responsibility for your trade. But you've just done something based on someone's input. And if you haven't done the work yourself to really understand it, to really understand if it's suitable for you, and to really understand, okay, how could this go wrong within my risk tolerance? What do I have to guard against to make me sleep at night? Not guy on podcast. He's done all that, right? He's a professional for the most part. He understands the risks. He's got his framework. He knows how to manage that. And between him making that actionable trade idea on the podcast and it being edited and aired 3 days later, his risk parameters may have been triggered all over the place and he's out. He's got no requirement, no obligation to come back on, find everybody that listened to that podcast and took his advice, say, hey, by the way, I just want to let you know I'm out. So it's a really, really complicated thing to do that has been made deliberately to look simple, and through the gamification of apps and the the toxic stuff that you see on CNBC, if you watch it without any cynicism, it's an incredibly dangerous world for people to be committing their capital. And you better understand that. So you always need to be cautious. But the thing you need to be cautious about is not what everybody thinks. It's not the markets. It's not the governments. The thing you need to be cautious about is constantly understanding what potential wrinkles trigger your own risk framework and make an investment that seems suitable for you no longer suitable. Ignore the price, because the price, John Burbank once said to me in an interview, price is a liar. And it is one of the single greatest pieces of advice anybody could ever get. And it was a throwaway line for John, who was just brilliant. Price is a liar. Price will lie to you all day, every day. It will make you believe one thing that isn't true. It will shake you out of things that aren't true. And so if you can understand that price is a liar, ignore it, and then just look at the shifting risk environment against your investment framework, your risk parameters, you will have a much better chance of either staying on the horse when price lies to you that it's time to sell, or selling something when price lies to you and says, hey, this is going to go up forever. And these kind of things, sadly, only come from experience. And I've said to my kids their whole life, I've said, there are things I can teach you, but there are things you have to learn. And I wish I could teach you everything, but I can't. I can try, but you have to learn some things. And price is a liar is something you have to learn. And the sooner you learn it, the better.
Very well said. Now, thoughts on emerging markets, Brazil, India, there's frontier markets out there too, such as Uzbekistan, that some people are pointing to as providing potential opportunities. When looking outside of North America, what is it that you see when it comes to the investment world?
The first thing I would say is that if anybody ever hears me talk about Uzbekistan and takes my advice, you're a complete fool. I know nothing about Uzbekistan. I could find it on a map. I would recognize its flag because I'm a bit of a flag geek. But don't listen to me about Uzbekistan. And don't listen to most people about Uzbekistan. In fact, find someone who lives and breathes Uzbekistan if you want to get into Uzbekistan, and listen to them on Uzbekistan, because Uzbekistan is Uzbekistan and not a lot of people know much about it. But when I look at outside emerging markets, as far as commodities are concerned, I would break them into two very distinct camps. And it just so happens that a lot of emerging markets fall into one of these camps. And that is exporters and importers. Because a lot of emerging markets happen to have a lot of commodities. And that's terrific for them. And that is, in many cases, their single biggest economic tailwind of their commodities. Some of them have the dual tailwinds of commodities and a positive demographic pyramid, which is perfect. That's about as good as it gets right now. If you have a great population pyramid, a healthy population pyramid, and you have a wealth of commodities, that's where people should be looking to invest. Not because it's Brazil or because it's Indonesia and we're interested in iron or we're interested in palm oil. That's not how to think about this thing. Because if I and other people are right about this being a commodity super cycle, there will be countries that have commodities that handle this very well. There will be countries that handle it very badly. And so emerging markets, in many cases, are in a similar position to Western governments in terms of their debt levels. And so if you have problematic debt levels and you have commodities, guess what you have? You have a means by which to ameliorate that first situation through taxation and, in some cases, confiscation of the latter. And that's a big deal. So again, people say, what do you think about emerging markets? Nobody should have a thought about emerging markets, because if you're going to lump Uzbekistan in with Brazil, you need to have your head examined, frankly, because they're completely different places with completely different population pyramids with completely different resource profiles, completely different government. There's so much more work that comes after what do you think of emerging markets. Now, you can buy an emerging market ETF, okay, but you might want to buy the Brazil ETF and short the Uzbekistan ETF. I don't know if there is one. I'm pretty sure there will be. Some enterprising young person somewhere at an investment bank will have put together an Uzbekistan ETF. So again, kind of this the generalization, these big broad themes are where the work starts, not where the ideas end and you buy the emerging market ETF. It's one way to do it. It's not the most efficient way, nor is it likely to be the most profitable way, except for the fact that you will benefit from the tailwind generated by all the other people who just say, buy the emerging market ETF. That will give it enough enough kind of fuel to potentially have a run. But what it means is the price action will again throw you off. If the emerging market ETF is going up because a whole bunch of people thought, hey, Uzbekistan's the next market, I'm going to buy the emerging market ETF. Guess what? Something happens in Uzbekistan. Those people start dumping the emerging market ETF they bought as a proxy for Uzbekistan. Anyone that's in, man, how many times have I said Uzbekistan on this podcast? Probably more actually than I have in my entire life in the last 5 minutes. All the people that bought the emerging markets ETF because they like Brazil, and that was the easiest, simplest way to do it, are sitting there going, well, hang on a second. Brazilian iron ore exports are at an all-time high. Why the hell is the emerging market ETF? It's because the Uzbekistan guys are dumping it. So it's very complicated. It's what I'm trying to say to you, Jesse. And I've taken a long time to do it. And I'm not avoiding the question at all. I think based on their commodity asset reserves and their demographic population pyramids in some countries, emerging markets, some of them are going to do very, very well. But you have to understand the predicament their government's in, their propensity to tax and confiscate, because all of these things are going to be on the table. All of them are going to be on the table if inflation stays sticky and rears its head in a bad way in some of these commodity countries, because the commodity complex is the most likely place for them to be able to generate the revenues they need to mitigate some of these problems they face.
Fantastic. Well, Grant, this has been an excellent conversation. I learned a ton. I'm sure the audience will as well. Before I do let you go, could you tell people about your newsletter, things that make you go, and where else can people find your work? Where's the best place to go? Is it through the newsletter?
Uzbekistan.com is the best place to find me. Look, everything is, I've got a website, grant-williams.com. The newsletter's on there, and I'm on Twitter at TTMYGH, which is just the acronym for things that make you go home. And that's about it. You won't find me on Instagram or Facebook or TikTok, or I don't know what the other ones are called these days, but I abhor social media. And Twitter is a useful tool, and I've learned a lot of it and met some fantastic people through it. But that's about it. Nice and simple, grant-williams.com.
Great. Well, I'll put a link to that as well as your Twitter for people who do want to learn more and dive into your work. Thank you once again, Grant, for coming on and sharing your knowledge with the audience.
Great pleasure, Jesse. Have a great time and safe travels.
And thank you for joining us today. As a reminder, this episode is brought to you by ARC Silver Gold Osmium. Go to arcsgo.com for all of your precious metals needs and contact owner Ian Everard today at 307-264-9441 or by email at ian@arcsgo.com, and make sure to tell him that Commodity Culture sent you. And I'll see you guys in the next episode. Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.